My name is Ariva Joseph. I am the founder of Blivos Academy. In Blivos Academy, we are dedicated to financial education and financial empowerment. So we teach you what you're supposed to know before you buy the shares of any company to make profit. We show you also how you can trade the forex market to make profit. We show you how you can also trade crypto and make profit. I've been on a series on things you have to look out for before you buy the shares of any company. And from that series, I'm researching companies, walking you through the 7 things you have to look out for before you buy the shares of any company. So in today's class, we are going to look at another company. But before we start, I want to talk about the 7 things you have to look out for before you buy the shares of any company. So the first thing you have to look out for before you buy the shares of any company is the company's revenue. Now, revenue of the company you want to buy their shares must be growing consistently for the past 5 years. So if you see a company you want to buy their shares, you have to look out for their revenue. And if you see that the revenue is growing consistently for the past 5 years, it has met the first criteria. Now, the second thing you have to look out for before you buy the shares of any company is the company's profit, or we call it net income. Now, the profit of the company you want to buy their shares must be growing also consistently for the past 5 years. So let's say from 2021, this is 2025. It is 2025 I'm making this video. So from 2021, let's say their net income was 4 billion. 2022, it has to grow to either 4.1 billion. 2023, it has to grow to like 4.2 billion. 2024, it has to go to like 4.5 billion. Then 2025, it has to be like 6 billion. There's supposed to be like an incremental continuous increase for the past 5 years. The next thing you're supposed to look out for before you buy the shares of any company is the company's cash flow from operating activities. But on financial statement, it is called operating cash flow. But I call it cash flow from operating activities. So this is the money, the amount of money a company makes from their regular sales and also manufacturing. So when companies do business, and the business involves sales and manufacturing, and it brings in money, this is what we call, and it brings in money, this is where we say it's bringing in cash from operating activities. So before you buy the shares of any company, the company's cash flow from operating activities has to be growing consistently for the past 5 years. If you're okay with that, we have to move over to the next thing you have to look out for before you buy the shares of any company. The next thing you have to look out for before you buy the shares of any company is a company's economic moat. Now, what is economic moat? Economic moat is what a company has now that is making them relevant now and will make them relevant in the future. Economic moat is what a company has now that is making them relevant now and will make them relevant in the future. So now, how do you determine the economic moat of a company? Let's say it's Presco or Okomu Oil or GT Bank. How do you determine the economic moat of these kind of companies? The first thing you have to do before you determine the economic moat is to identify the industry of the company you want to buy their share. So let's say for Presco, we now discover that Presco is in agriculture or processing and storage industry. Now you now discover the next thing you look for is also other players, other companies in processing and storage industry. When you find other players in the processing and storage industry, the next thing you look out for, you're looking out for the major player in the processing and storage industry based on their revenue, profit, cash flow from operating activities, and the number of customers. So when you've identified all the players in the particular industry of the company you want to buy their shares, you'll now look for their revenue for the past 5 years, their profits for the past 5 years, their cash flow from operating activities for the past 5 years, their number of customers. So for all these companies in that particular industry, now the company that has the highest number is the king of that particular industry, is the major player. Now, economic moat is what the company has now that's making it relevant now and also make them relevant in the future. So we have discovered the company that is relevant now. We want to know whether this company will be relevant in the future. How you do that is by researching to know the current technological innovation, the industry, the company you want to buy their shares is working on. So for Okomo Oil or Presco, we will research to know what is the technological innovations they are working on, what is the patents they have, because these are the things that will still keep them relevant in the future and make them the industry players. So if you're okay with that, we'll move over to the fifth thing you have to look out for before you buy the shares of any company. The fifth thing you have to look out for before you buy the shares of any company is the company's current ratio. Now, I want you to understand that current ratio is current assets divided by current liabilities. It helps investors to know whether a company will be able to pay their short-term debt. So, if for Presco, let's say still Presco want to buy their shares, for Presco, we check their financial statement and we discover that their current ratio is less than 1. It means Presco will not be able to pay their short-term debt. So it's a company you have to avoid. But if we check their financial statement and we discover that Presco current ratio is equals to 1 or greater than 1, we are certain that they can pay their short-term debt. So this is the fifth thing you have to look out for before you buy the shares of any company. Now the sixth important thing you have to look out for before you buy the shares of any company is the returns on equity. Now returns on equity is net income divided by shareholders' equity. So if the value is less than 10%, you should avoid this company. So you look out for companies. The company you want to buy their share, let's say Presco, we discover that their return on equity is less than 10%. We'll avoid them, because we want a scenario where if we put in $1,000 in Presco or 1.5 million naira, as the case may be, at the end of the year, after 1 year period, we're supposed to get 100,000. So if we are compounding that in 10 years period, I think that money should grow to like 6 to 7 million naira. So you have to look out for the returns on equity and know of a certain that it is not less than 10%. So the next thing you have to look out for, which is the most important, is the core intrinsic value of the stock. So want to find the intrinsic value of Presco, the company you want to buy their shares. Now, why do we have to do that? We have to do this because there is one of my analogies that states that a good company can be a bad investment if you're buying this company shares at the wrong time. Now, the important question to ask here is, what is a good company? When is the right time? Now, a good company is a company that has consistent growing revenue for the past 5 years, consistent growing profit for the past 5 years, consistent growing cash flow from operating activities for the past 5 years, a strong economic moat, their returns on equity is not less than 10%, their current ratio is equals to 1 or greater than 1. So these are the qualities of a good company. So if you found a good company, the next thing you have to look out for is whether this company is overvalued or undervalued. By overvalued, I mean the share price of this company is too costly. And how we know the intrinsic value of a company is by using intrinsic value calculator. For my premium students, I give them our calculator for them to use to know the real share price of a company. So if the real share price of a company, after we do our calculation, is greater than what is quoted in the stocks market, it means this company is undervalued. It's the right time to buy. If we do our calculation and now discover that the share price of the company from the calculation is lower than what is quoted on the stocks market, it means that company is overvalued. Avoid it. keep it in your wait list if it is a good company. If it's not a good company, avoid them. So let's move over to doing practicals. I'll show you how to read financial statement of companies, how to find the revenue, profit, cash flow from operating activities, current ratio, intrinsic value, and returns on equity. So the web application we'll be using to carry out this exercise is investing.com. So if you type investing.com, it's going to load up. So when it loads up, to the top right, you'll see a search bar, and the company we want to research today is Presco. So Presco PLC has come out. I'll click on it. Okay, you can close. To the top right, you see a close icon, a close button, or a close tab. So you close out of this advertisement. So we are researching the intrinsic value. Not just the intrinsic value. We want to look at the financial statement of Presco to know whether it's a good company. After that, we'll be checking whether Presco is selling at a good price for us to buy. So you click on financials. Okay, it has loaded. Now we'll look for the revenue. The first thing I told you is that the revenue of the company want to buy their shares must be growing consistently for the past 5 years. So we have a record of 23,891. That is the revenue for 2020, and all the numbers here, you multiply them by 1 million. So 23,891 times 1 million is 23 billion. So we'll go to 2020. Let me highlight total revenue so I can see where I'm reading from. I don't know. Yeah, you can see the highlighted portion. So we'll go to 2021. For the revenue for Presco is 47 billion, 47.2 billion, 0.4 billion. 2022 is 81 billion. 2023 is 102 billion. 2024 is 207 billion. The next thing we'll look out for is the net income, or we call it the profit. I call it net income. Net income is profit after tax. So we want to check whether the net income of Presco has been growing consistently for the past 5 years. We have just seen that for their revenue, it has been growing consistently for the past 5 years. So they have met our first criteria. We'll check for the profit and check whether it has also grown consistently for the past 5 years. So for 2020, it's 5.2 billion. 2021, 19.3 billion. 2022, it dropped to 13 billion. 2023, it rose to 32 billion. 2024, it rose to 76 billion. So Presco has had 4 years of consistent growing net income in 5-year period. The next thing we'll look out for is the cash flow from operating activities. I told you that cash flow is the money that cash flow from operating activities is the money the company makes from business activities like sales and manufacturing. So we want to check for Okomo Oil, what is their cash flow from operating activities and whether it has been growing consistently for the past 5 years. So for 2020, their cash flow from operating activities, look at it here, let me highlight it so you will not make mistake. Cash flow from operations is 11.899 billion. For 2021, is 20.97 billion. For 2022 is 31.79 billion. For 2023, it dropped to 23.37 billion. For 2024, it skyrocketed to 89.68 billion. So Presco also has had consistent growing cash flow from operating activities for the past 4 years in 5-year period. So we can say they have met our benchmark. Now the next thing we want to look out for is the company's current ratio and returns on equity. So you scroll down and look for the place that say ratio, still under the financial tab. So you click on it. So this is how we search companies. Returns on equity. Returns on equity is under management effectiveness. You can see it here, returns on equity to the right is 84.63%. Now you will not use this value, the second value. Use the first value, 84.63%. Trailing 12 months. TTM stands for trailing 12 months. So for the past 12 months, from September this year, September 2024 to September 2023, their returns on equity was 84.63%. So at the end of this year, they are going to report 2025 data. So for this year, they have not reported their data. But at the end of 2025, they're going to report their data based on investing.com. So Okomu Presco PLC, their returns on equity is 84.63%. So we are not going to go over to current ratio. This is current ratio. Current ratio, I told you, this current asset divided by current liabilities. It helps investors to know whether a company will be able to pay their short-term debt. So for Presco, their current ratio is 1.37. This MRQ stands for most recent quarter. Most recent quarter is the most recent first 3 months. So their current ratio is 1.37. So it means Presco will be able to pay their short-term debt. So it's a good company. We can buy their shares. So now we have identified that Presco is a great company, it's a good company. We want to look out for whether Presco will be able to, whether Presco at this price, 1,447 naira per share, is the right price we have to buy their shares. So we are going to use the intrinsic value calculator I give my premium students that are willing to pay. And I'm going to use the calculator now. I'm going to put Presco PLC. The next information we're going to put in this calculator is Presco free cash flow. So we'll go back to our investing.com website and look for their free cash flow. So I'm going to, under financial, I'm going to still click on financial summary. It's opening. Scrolling down. So this cash flow, levered free cash flow for the year 2024 is 107 billion naira. So I will go back to my calculator and input 107. Let me go back. 107,421. 107,421 multiplied by 1 million. So we just put 6 zeros at the end. 1, 2, 3, 4, 5, 6. It has given us 107 billion naira. Now remember that Presco returns on equity was 84%. 84 point something percent. Let me just put 84. Now the period, okay, this is where I have to explain. Now period stands for the year in the future we are trying to know the worth of Presco based on their free cash flow. Let me explain why I made this statement. The formula we are using to calculate the intrinsic value that this calculator is built on, the formula is the discounted cash flow formula method. Now with this method, it tries to know the worth of a company in the future based on their current free cash flow. So that future period is what is called period now, and that future period should not be less than 10 years. So from 10 years and above, we want to try to estimate what will be the worth of Presco based on their free cash flow. And you know their free cash flow is 107 billion. So we want to know in 10 years period, 11 years, 12 years, 13 years and above, what will be the worth of this company. Now when we know the worth of the company, we are going to divide it by their outstanding shares. From there we are going to get the intrinsic value of Presco, intrinsic value of Presco shares. So let's use 12 years period, what will going to be the worth of Presco based on their free cash flow. Now, the next information we have to look out for to impute in this calculator is the outstanding shares of Presco. So we'll go back to our investing.com. Let me show you how to find outstanding shares. You click on General. Now, there are two ways to find outstanding shares. The first way is to use this calendar. The first way is to use the calendar, this website, and you look for the place under General. You look for the place that say ownership. If it is not available, you're going to carry the share price of Presco. The share price of Presco is 1,447 naira. So you're going to divide the market capitalization of Presco by their share price. So market capitalization is outstanding shares times share price will give you market capitalization. So now we are not able to find the outstanding shares of Presco, but we have known their share price to be 1,447. We are going to look for the market capitalization. So you just scroll down. We'll scroll down to find that the market cap of Presco. So we'll click on size. I don't know whether you saw where I came to. Click on growth, profits. I'm looking for the market cap value. Quote. Okay, yeah, look at it here. The market cap of Presco is 1,480 billion. So 1,480 times 1 billion is 1.4 trillion. So 1.48 trillion. Let us put in our calculator. 1,480 times 1 billion. 1 billion is 9 zeros. Is, look at it, 1.48 trillion. So we'll press equals to. Now we'll now divide it by the share price of Presco, 1,447. So the outstanding share price of Presco is, let me copy it, whether I can copy from here, is 1,022 million. 1,022 million. So we are going to copy 1,022 million back to our calculator. $1 billion. So 1 billion. I'm going to put other zeros here. So we are going to carry this value 1,022,805,805 and put in our calculator. Let's go back to our calculator. 1 billion 805. Am I correct? No. 805. Now the share price of Presco. Share price of, what's the share price of Presco? Okay, let's go back to our investing.com. The share price of Presco is 1,447.50 kobo. So we'll go back to their calculator. 1,447.50. Let's check our calculator again whether, yes, 805. So let's go back to our intrinsic value calculator. We have put the free cash flow. We have put the returns on equity. We have put the year period. We want to know the worth of the company based on their free cash flow. We have put their cash flow, their share, outstanding shares. We have imputed the share price of the company. So we'll click on calculate. Now, the intrinsic value of Presco PLC. Now, this calculator was built by us, our engineering team, and the value is in dollars because we used to use it mainly for foreign companies. The intrinsic value of Presco is 121,249 naira, and it is 16% overvalued. 16% overvalued. So we have seen that Presco is a good company, but currently Presco is 16% overvalued. So we are going to wait for Presco to drop below 1,249 naira before we buy Presco shares. So this is how we calculate the intrinsic value of company to know whether it is the right time to buy the shares of a company or not. So I am Arira Joseph. I bring you financial education. I educate you on how you can identify good quality companies in the stocks market and also the right time to buy their shares. Take charge.